Today is Tuesday, September 8th, and this is a post-market review for the stock market activities today. And what a day it was. Massive decline day, a sell-off. We will discuss it in details. So here is the agenda of the day. And here we go, the Dow Industrial Average closing down in the red, a decline of almost 632 points or 2.25%. The Nasdaq leading the decline severely, down 465 points or 4.11%. We saw, of course, Apple down more than 6% today, Tesla down more than 20% today, contributing to the demise of the Nasdaq. What's going on with the S&P 500? Down 95 points or a decline of 2.78%. Moving on to the sector's performance. No medals today. We're not giving any medals. Nobody won. Nobody closed in the green. All sectors closing in the red. Led, of course, by technology, consumer cyclicals, and energy. And when we move on to the futures market, again, bad day across the board. With few exceptions, you saw crude declining significantly today. Big red day for crude, erasing all the gains since July. Lumber continues to collapse here from its own bubble. Coffee down, cocoa down, OJ down. And of course, metals were mixed. Copper, palladium closing in the red. Gold, silver managed to be muted today. Sugar closing in the green. So did canola, soybean, and corn due to the shortages of supply. And now, switching to the big casino, the gambler's market, and what dictated the moves in the stock market as of late. What is going on in the options market? You see the fear. They've been shaken out. If you've been watching this channel, you know the last few weeks we've witnessed call options mania in names like Apple, Tesla, Facebook, to the tune of 75%. 85% of all options traded as calls. You see the picture is starting to change here. There's a little bit of fear that the gambling and buying calls on autopilot might not work forever. Specifically when you're gambling on weekly options that will expire in the same week. That worked for the last couple of weeks, the last weeks of August, and the gamblers rejoiced, and now they're taking it on the chin. You will see severe and significant losses from those Robinhood traders who are specifically trading weekly call options, pouring a lot of money on a lottery ticket. That is going to end very, very badly for most of these traders. And as you can see, the volume for Apple down significantly from Friday and the last few weeks. 2.8 million options traded today, 66% of those are calls. Tesla, 1.3 million options traded today, 56% of those were calls. And coming at number 3, Bank of America, 450,000 options traded today, 58.5% of those were calls. And now, moving on to the headlines that shaped the day. We don't have a lot of headlines here, besides some corporate related headlines. Of course, the first headline we heard in the morning is from General Motors and Nikola collaborating to produce the Badger pickup truck. And of course, General Motors stock and Nikola stock rallied significantly today in contrast of the demise of Tesla. Tesla took it really hard on the chin today. Nikola, General Motors having a good day today. And of course, if you've been following me, you know that I'm an investor in General Motors, and I've been trying to convince you to add General Motors to your portfolio because the company is shifting from a boring, dormant company that people bought solely due to the dividend into a momentum stock with new innovations and new avenues in creating future revenues. The collaboration with Nikola is one of those. The Cadillac electric vehicles, all the shifting to the electric vehicle production from GM will add to its momentum. Of course, we had the news of General Motors collaborating with Honda now. General Motors been criticized as an unreliable producer And now, of course, they're collaborating with one of the most reliable producers in the world, Honda. That should add to the quality of General Motors vehicles. And moving on to other headlines. What's going on with the maniacs, the dummies who've been buying stocks and they think that stocks go up all the time? Here is their leader, Davey Barstool. Davey Barstool had a very bad day today, lost almost $4 million. He's been, of course, deceiving these young investors and naive investors into following him. He's, of course, doing this for fun. If he loses $1 million, $2 million, $10 million, it wouldn't matter. He sold his company for over $100 million. He has more than enough resources. This is just for entertainment for him. But the donkeys who've been following him, thinking that stocks only go up, and Warren Buffett doesn't know anything about stocks anymore, he's too old, and just buy everything so you can have a monopoly board. The stupidity that we've heard from this guy have deceived investors, and now they're losing their money. The difference is Dave Barstool doesn't care. He's just going to go back to sport gambling, and he has a ton of money. But his followers are going to lose it all. This is the risk, and this is why a lot of people raised the flag against this guy. Nobody checked him. The SEC didn't check him. CNBC, and of course Jim Cramer. Oh, my friend Portnoy, he's doing a good job. He's amazing. You know what he's doing is wrong. Yet you're too much of a pussy to criticize him because you are afraid of the backlash from his cult. And of course, moving on to the circus in Washington, D.C., now that the stock market is down 3 days in a row, all of a sudden Congress is feeling the urgency to pass that COVID stimulus deal. Before, when people were losing their jobs and being on the brink of being evicted from their homes, and about 30 million Americans not having enough to eat, who cares? That didn't motivate them whatsoever. But 3 days in a row, red days, all of a sudden the urgency comes in, and let's make a deal. Let's pass some stimulus, whatever it is, to help and rescue the market. And they're saying we can do it as soon as this week. Of course, they will. And McConnell is now proposing $500 billion. This is the skinny deal. The skinny deal is $500 billion. That is in debt, of course, that will be passed to the next generation. In the skinny deal, there is no stimulus. The $1,200, you're not going to get that. You're only going to get $300 a week for unemployment. That is it. The rest of the money goes to corporations, of course. And now, let's switch to the heat map analysis. As you can see, it is a sea of red with very few exceptions. Disney, Uber, I don't know why the hell Uber was up today. Some names in the healthcare sector, and of course General Motors had a pretty good day today. Beside that, and honestly it was disappointing because I was expecting a rotation trade. Certain sectors should outperform as money comes out of technology. We did not see that. We've seen everything being hammered, taking uppercuts left and right. And that could lead us to another discussion later on, whether this was a panic. And panics usually signify the bottom of a correction, at least from a short term. Was it panicky enough? We will discuss that in a little bit. But let's move on to the rotation trade. Here is the update for the rotation trade today. As you can see, there was no rotation here. Tech got hit hard. Granted, the comeback stocks got hit just slightly. Certain names managed to close in the green significantly. Disney, Southwest, General Motors, of course, we talked about that. But all in all, it was muted. To justify and to validate the rotation trade, we need to see money coming out of tech and momentum stocks into the comeback stocks, not just 1 day, not 2 days, but week after week. We need to see sustainable move, however, not as impulsive as we've been seeing here. If tech drops significantly, as you've seen today, Tesla down 20%, Apple down over 6%, that is impulsive. It is not an attribute of a rotation. A rotation happens over the course of weeks and months, and you see declines, half a percentage point from the momentum stocks or from wherever stocks you're rotating from, and then again of a percentage point, half a percentage point, quarter percentage point to the names you're rotating to every day. But these impulsive moves down 10% on one hand, up 10% on another hand. That is not sustainable. These are impulsive moves, and that's not how rotation trades work. So we're still tracking and we're still waiting to see the manifestation of the rotation in a sustainable manner. And now moving on to the charts analysis and starting with a daily chart of the SPY, the S&P 500. As you can see, we're down almost 6.5% from the highs. Massive decline in a short amount of time. And guys, we better bounce from these levels. We better bounce tomorrow, because if we don't and we continue to slide, this could get really, really ugly in an epic and historical way. Because the next meaningful support that I see here is at 323. That is far below. It could be a lot of pain to come here. And when we switch to the 15 minutes perspective, today's action was brutal. It started gapping down and it just continued to grind slowly to the downside in a very painful death kind of way. It was not fun if you had any calls or long positions in the S&P 500. We didn't see any bounces or any mini rallies, nothing. It was just slow, painful death. Likewise, when we switch to the Qs, the chart of the Nasdaq, from a daily perspective, I tweeted this in the morning, expecting a small bounce in the morning and then a resumption of the slide downward. This is exactly what happened. The Qs had a bounce for about 5 minutes and then resumed the slow, painful death, grinding lower and lower. It was not fun to watch if you were along the technology sector. However, as you can see here, we have caught support. You see the blue line where we stopped here, barely catching support. Will it hold? You better hold that support tomorrow and bounce from it. That is at least my expectations. After a correction of over 11% in a short amount of time, and the kind of behavior that I saw today of traders and the gamblers and the Robin Hood idiots pretty much giving up today. Their heads were down. They were not gambling again in the options market in the same manner they were before. You can feel the fear starting to creep in the market and scare those gamblers away. And that is usually comes at the end of the decline, at least for the short term. And we should bounce from here. We better bounce from here tomorrow and start a mini rally, aka a dead cat bounce, before we resume selling again. And that leads us to the daily chart of the triple Qs. You see the support, the trend is gone. We've already broke the trend. The trend is scrambled eggs right now. We can try in a bounce to catch it, but for all intents and purposes, the trend is gone. And I say I expect the Qs to bounce tomorrow, or at least at the latter part of this week, because if they don't, this could be really painful. I see the next meaningful support at 235. That would mean another 10%, meaning that the Qs corrected from the top to the bottom 20% in the matter of days. That is insane. It is possible. It happened before, but it's very, very rare. But this is what we've been warning about. Be careful, stay disciplined, book your gains, get the hell out of the bubble, because when they break it, the stock market will erase all those gains that took months to build. Will erase them in a matter of days. And you're seeing that happen right in front of you. And now continuing, of course, on the discussion from last night. Here is a weekly chart of the Qs. We talked about the MACD crossing from a weekly perspective as an indicator of the end of the trend and the breakage of the trend and the decline thereafter. However, be careful here. This is a weekly chart. It is not done until the end of the week. It doesn't count until the end of the week. If we see a big bounce tomorrow in the Qs, that could change. I know a lot of you looked at the weekly chart today and said, aha, this is it. We crossed the MACD. Goodbye to the trend and to the Qs, and let's go all in shorting the Qs. Wrong. It only counts at the end of the week. Stay disciplined. Stay careful here. We're watching and we're waiting. But for all intents and purposes, the trend is gone. We just need to wait for the weekly confirmation here. And when we move on to the dollar index chart from a daily perspective, remember yesterday I tweeted this tweet saying if we break from the downward channel in a meaningful way in the dollar index, that could coincide with a massive decline in the stock market as the rush to cash or raising cash takes place. And this is of course what the dollar index did today. A continuation of this move will mean more pain for the stock market, and watch the dollar index because it could be your indicator. Say tomorrow the dollar index opens higher, then starts to decline and close in the red. That would be your signal that the correction is taking a breather for now in the stock market. And of course, let's review gold. Gold from a weekly perspective here. You see gold staying dormant, taking its time, allowing the 20 weeks moving average to catch up to the chart after a very impulsive move. This is the healthy way for any chart to react after a major divergence from its 20 weeks moving average. I expect gold to gather some energy, allow the 20 weeks moving average to catch up to it, and then rally thereafter. So this is an opportunity to start small positions in gold. And now let's conclude this video. You know that we've been warning over and over again about the bubble and the stock split mania that is not justified in Apple and Tesla stocks. And we said that as Apple and Tesla go, so will the market. As long as Apple and Tesla continued to ride higher, so did the stock market. And as soon as Apple and Tesla broke, you see the stock market breaking as well, because it is a defeat for the momentum and the so-called safety trade in buying Apple. You defeat safety, you defeat momentum, you defeat the stock market. And the lesson here, you have to pay attention to technicals and to market sentiment. Valuations matter. They don't matter until they do. And now they matter, and you see Apple and Tesla giving up a lot. Tesla down over 20% in one day. If you are a trader who bought, say, Tesla at 500, you have to sit down and review your decisions. Was there any rationale there? Were you aware of any of the facts or any of the valuations or the technicals or anything about Tesla? Or were you just following the hype and the morons on TikTok and YouTube who have no experience whatsoever in the stock market giving advice on pumping certain names? This is an opportunity for you to reflect and to adjust your strategy from this point on. Now, here is the danger that I see for the stock market in the coming days. I believe that algos took over now. The selling pressure triggered algos, and algos could continue to sell aggressively and irrationally, and they could crash the market significantly and severely here until the human trader stopped them. The human trader is very afraid of buying stocks right now. Add to that the fact that the Robin Hoodiots been buying stocks and options, buying options on margin, which is unbelievable, just unbelievable. I've been trading for years and years, and I've never used margin to buy stocks, let alone options. Expect those margins to be cold now. You combine that with the algos taking control and the fear of certain traders from buying the dip, and we could have a nightmarish scenario here in the stock market. So we better have a bounce tomorrow to lift up the morale of traders, to take over algos and rally the market a little bit before we resume the selling again in a healthier manner. So to summarize my expectations, I'm looking for a bounce soon. If that bounce doesn't happen tomorrow, doesn't happen Thursday, then oh boy, we might go to the nightmare scenario. So buckle up your seatbelts, because this one is becoming an extreme thrill ride. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.